So let's now look at Tiger Brands and their interim headline earnings per share up 4% to 818 cents. And the group said increased volatility and inflation in soft commodity prices negatively affected volumes and profit margins. CNBC Africa's Warren Dick asked Tiger Brands CEO Peter Matlare about their numbers.
If you reverse DFM and you take our rice business and put it aside, you've seen some reasonable sort of 6% growth in organic growth in turnover, etc. The reality for us is the South African consumer remains under pressure. So we believe these results within this particular environment are reasonable. They're not spectacular by any stretch of the imagination. And they also demonstrate quite clearly why it's important for us as an organization to keep reformulating our architecture in order to deliver better value to the consumer.
So the volume growth you've regained, but it's obviously been at the cost of margins. You mentioned the currency effect of buying that Thai rice. How great is the effect of the currency in a business like that?
It's quite significant, given that we import all of that rice, and so you'd see the Thai rice in dollar terms prices come down $50, but with our rand going the other way over the same period, that's virtually nullified or muted that differential that we would have expected. So it has a significant impact on that Thai rice price, and it's not peculiar to us; it's the market in general.
I think just to counteract that, you've obviously got the exports and international business, which I take would actually benefit from the rand's weakness. That had a very positive performance for the period. 12% growth in turnover and a rise in operating income of 8% to 265 million. So you mentioned in the dialogue that the foreign currency gains offset the weak demand that you're seeing from places like Europe. Perhaps you could just colour that some more for us.
Absolutely. So with respect to Europe, the particular business that exports to Europe is our Langeberg and Ashton Foods business, which is our canned fruits business, etc. And quite clearly we've seen muted demand coming out of that market, given the state of the European economies in general. So there it's not necessarily been simply around pricing. Last year there were some pricing increases that we took, and successfully. This year we've seen pricing upwards is very sticky, and therefore we've seen volumes quite muted coming out of Europe. On the other hand, if you look at the balance of our continent, our exports business has continued to grow really healthily, and we're very pleased with that particular success of the exports business. And linked to that, the Davita business that we bought about a year and a half ago, 2 years ago now, has also performed particularly well. We did have some work stoppages in the first quarter of this year, so that was around about October, November, which impacted our first quarter performance. But I've got to tell you, once we sorted those out, the second quarter has been going gangbusters. So we've seen in Nigeria, in Tanzania, in Uganda and Mozambique some strong growths. And again, it underpins the strategy that we've been talking to.
So at the moment, would you say it's fair to say that the African involvement, the African export market is by and large taking the share of being able to grow that business? So whatever you're offsetting in Europe from weak demand is being more than taken up on the continent.
I wish it was quite as nicely balanced as that. Remember, so the export business gaining nice momentum. A number of our other businesses on the continent are relatively small, however, relative to our South African business. So where we take strain in South Africa, it's not automatically offset as we would have liked it to be. And we'll see these grow organically and by acquisition, and we'll see that offset coming over time. But you're clearly seeing in a number of those businesses strong growth, given the work we've put into those businesses over the last 5 years.
We've got to get just touch on consumer brands, holding level at 4.8% with operating income rising by 5% to 854 million. Just indicative, I think, of the economic situation the country kind of finds itself in at the moment.
Absolutely. Look, I think given the breadth which consumer brands plays across, that's a clear indication, it's a great barometer for where the South African consumer is. In that business, our groceries business, the culinary business, certainly was the biggest underperformer in relative terms, and it's also the biggest business in that particular sector. But you know, our snacks and treats business, which is a kind of chocolates and sweets business is the right way to put it, have performed particularly well. Our beverage business, because of pricing issues, had a bit of strain in there, but we've had strong performance in our enterprise business, the value-added meats business, as well as in our out-of-home business. So, you know, that portfolio is reasonably nicely balanced. I think, notwithstanding all of the pressures that the consumer is under, we've been able to regain some volume shares in that business, as well as had exercised some pricing power in a couple of the categories.
We've got to, before we close off the interview, we've got to talk about Dangote Flour Mills, a fairly big acquisition for the group, which you completed in October last year. You mentioned it's still having quite a tough time. You've essentially effected a turnaround plan with Dangote. Just take us through what you plan to do to bring that business to its optimal level of profitability.
What we're going to do in DFM is precisely that which we've done in Kenya, in the Cameroon, in Ethiopia, and in UAC, which is also in Nigeria. And that's about fixing what we've called the back end. So from procurement, putting in our people to help change the procurement processes right the way through the manufacturing process, and there are two specific things are happening. The one is we're working with Beulah, which is one of our international suppliers and partners, to make sure that we have these assets performing at the optimal levels. The other is training the people within the business and putting in systems and processes, whether it's around asset care and maintenance, etc., in order to improve the delivery of those businesses. Now, I start there because that's what we've done here. That's how we've built our businesses here. It's a capability Tiger has and has demonstrated. And then obviously on the front end, it's about route to market. So on the distribution side, we're working with companies like Imperial to recalibrate our go-to-market distribution, whether it's around the number of trucks, where we're going to have warehouses, etc. So that's working really nicely for us in terms of evolving that plan. And then we in market have been doing a lot of work with our marketing teams out of South Africa that are now working quite extensively in Nigeria, developing go-to-market strategies, which brands, which pack sizes, which format. And so whilst that'll take us 18 to 24 months, it's a tried and tested plan led by a very capable team. You know, young Thabise Khwale, who's gone to head up that business, he went in about 6 or 8 months ago, very successfully ran our grains businesses here. He has extensive and deep knowledge of the grains businesses, both here and in previous employment that he's had. So I'm very confident that we've got the right people. Now it's about rolling the sleeves up and doing the hard work.